Hello, everyone. Welcome to our presentation today, How Cybersecurity Affects the Valuation of Privately Held Mortgage Companies. This presentation will be put on today by Ray Hutchins and Mitch Tannenbaum. We're partners in a full-service cybersecurity company headquartered in Denver, Colorado, and we happen to have a very vibrant mortgage company business as a result of Mitch's previous technical and business experience in the mortgage industry. Mitch, would you please tell the audience about your experience?
Well, I spent about 20 years in mortgage technology and mortgage services working for a large privately owned firm that was in title, settlement services, mortgage documents, real estate services, and a variety of other real estate related technologies.
So as a result of Mitch's experience and then our company's experience in this area, we've got multiple mortgage companies as clients. Mitch is regularly featured in the Rob Christman's newsletter. We're members of various mortgage lender associations in the country. We do various and sundry mortgage webinars. So we've got a lot of experience in this, and there's something that affects all of you folks out there that own mortgage companies. And that's why cybersecurity should now be a key consideration in any mortgage company valuation. And that's what we're going to talk about today. So we're going to try to move through this pretty quickly to give you, if you have any information, if you have any questions about it, please ping us. Be happy to tell you more about it. If you have any cybersecurity needs with respect to your company, touch base with us. We're your folks. So we're going to talk. Here's an overview of what we're going to cover. Why cybersecurity should be a key consideration in any mortgage company valuation. Different types of business valuations can be affected by cybersecurity issues. Real life examples of the effect on cybersecurity on valuations. Benefits to clients, benefits to valuators. I notice there'll be some references in here to valuators here. And that's because when we first put together this particular slide deck, this is part of a slide deck that we were using to train business valuators because they are now being called upon to factor in cybersecurity in their valuations. So you'll see a few references to that, but no big deal. You'll get what we're talking about here. We just want you to get the point. This matters now. You need to make changes in your operations to make sure you get the most value for your company. And then how to determine if cybersecurity is really a valuation factor. If you're in a mortgage business, it's a valuation factor. We can tell you that already. So, number one, risk affects valuation, and cybersecurity is a risk. Any questions on that issue? I mean, that's the way it is. All mortgage companies today operate on top of an IT infrastructure that is inherently insecure. Notice I say all mortgage companies. The greater the dependence on IT infrastructure to operate the business, the greater the risk. If a mortgage company cannot effectively defend its IT systems and its data from attack, then it's worth less than a competitor who can defend itself. Mitch, you have anything you want to add to that?
Nope, you're good.
Okay, in today's world, a company's value is directly related to the value and amount of client/loan data, intellectual property data, application, your software data, third-party vendor data, the amount of unmitigated cyber risk. The more data you have, the more data related to your clients, especially in the mortgage industry, your value is impacted if you're not protecting that. I mean, you can lose your reputation very quickly over that. Additionally, that value is impacted by accessibility to that data, security of that data, safety and security of the systems required to use that data, and commitment to security by the people controlling that data. In the mortgage lending industry, that's where we see a huge problem. The leadership of the mortgage lending industry, by and large, is not that committed to protecting the data that they are responsible for. Anything, Mitch?
No.
Nope. Okay. If a mortgage company owner is not aware of these issues and does not ask questions related to these issues, then how can the owner establish and defend the company's true value? That's just a reality in today's world. It's just a reality. We're going to give you some situations where cybersecurity can affect a business value. Of course, sale or purchase of the business. You put us on the side of a purchaser of a mortgage, someone trying to buy a mortgage company, we're going to look at cybersecurity right away, and cybersecurity isn't there. We're going to knock 30-50% off the deal. If we might even just walk away from the deal, because if you're not protecting that data, and you can lose your reputation overnight because you're doing such a crappy job with that. Well, why do we don't want that? We don't want to buy that liability. And so it's involved in sales or purchase of business. Cybersecurity is an issue. Ownership or marital disputes, bankruptcy procedures, bank or other finances. Bankers are getting ready to start looking at cybersecurity due diligence to loan you money. And why not? I mean, if you don't have good cybersecurity, you're not a good risk. Odds are maybe you can't pay it back. You get breached, your reputation is damaged, your business goes down, you can't pay back a loan. Taxation, reporting purposes, litigation support purposes, a lot of this going on out there where they're using cybersecurity as part of that. Determination of intellectual property or blue sky values, establishment or justification of share equity, stock option values. All of these factors which relate to valuation, cybersecurity is now a component of that. And you need to know about it. Here's some real life examples. Okay, we're going to use some large public companies examples because there's data available on these guys, and there's not data on smaller companies yet. That'll happen. And we're focusing on this because large companies have got the resources to deal with the breach. Small companies just fold up their tent and go away, or they file for bankruptcy or dissolve, where big companies can absorb it, and then the information is out there that we can look at and we can study to see how does cybersecurity affect the valuation of a company. So we'll talk first about Target. Mitch, would you like to talk about these couple of breaches that we have here?
Sure. So in the case of Target, they lost tens of millions of credit cards and even more loyalty cards. And what was the consequences? They paid millions of dollars in fines, more millions of dollars in settlements. Total they spent as of 2016, which is several years ago, about $300 million, of which they got about $100 million reimbursed by insurance carriers. Still means that they wrote a check for $200 million. And the costs are continuing to pile up. They're having to put sales on to go get customers back in the store. And the result of that is a lot of money. Now, scale this down, let's say it's 1%. If you had to write a check for $2.9 million, could you do that? What's the consequence to the business? So that lawsuit is still not resolved. It's ongoing. And clearly there's a significant amount of distraction on the part of the key management of the company. If there's a sale, what is the liability? And we'll talk about that in a second with the Yahoo breach. And how has this impacted value? And even in their cases, if it didn't impact a long-term value, it clearly impacted short-term value. In the case of the Yahoo breach, there was no credit cards involved, but there were 3 billion user accounts that were compromised. And that was right at the time which Yahoo was purchasing them. So the purchase price went down by about $350 million, which is significant, obviously, to the Yahoo shareholders. In addition to that, Yahoo got to keep some of the remediation costs, some of the fines, some of the litigation costs, and that's still not fully settled. So, we have two really big publicly traded companies with lots of financial resources and legal support. In 2013, when this first happened, Target had to, put sales on in order to get people back in the store. The conversation still was, even in spite of the sales, was, oh yeah, Target where the breach was. And I talked to many people who said, yeah, maybe I'll just go someplace else, or if I won't go someplace else, I think I'll just pay cash, which typically translates to a smaller sale. And the big question is, what does a smaller company do? If you figure that you have a breach which is 1/100th of the size of that, and it costs you $1 million, could you weather that? Do you have insurance? Would this insurance cover it? And that's the thing I think we're talking about here. In the case of Marriott and Sotheby's, they were both in the middle of acquisitions. Marriott acquired Starwood, and Sotheby's acquired Home, and both of these had hackers inside the organizations at the time that they acquired it. And when these guys bought the companies, they bought the liabilities. So they now own that liability if these systems are hacked. In the case of Marriott, we think it's probably Chinese nation-state actors who wanted to know what Chinese expats were doing. In the case of Sotheby's, we don't know a motivation. But in both cases, these guys have the liability. We don't believe there was any holdback or retained liability. So now it becomes the buyer's responsibility. Right?
So now again, we're talking about benefits here, considering cyber risk in valuation. You're providing a more accurate valuation, obviously, because you get you're defining risk better. You're helping your client. If this was remember aimed at a valuator, you're helping your client better understand and protect your data. It's the same thing for mortgage companies. You'd be helping you do it. You reduce the risk and liability associated with valuations. Now, how to determine if cybersecurity is really a valuation factor? Sometimes it's not. For some businesses, it's not. But for mortgage lenders, it is. We already know that. So, but here is, we've got a process for kind of determining this. We set 10 questions that a evaluator can use. So if you were going to sell your company and you're using an evaluator, don't be surprised if they don't use these same questions on you. So let's see how you do with this. So we have a free service for evaluators where we give them the questions. They ask these questions. If they have a high score that we've given them that shows they may have issues that negatively impact the company's value, then we do a full risk assessment. But here are the 10 questions. See how they apply to you today. Does your company have sensitive data that is responsible for protecting that it might be of value to competitors, criminals, or foreign governments? Yes, in the case of mortgage lenders, you've got everything. You've got everything. We don't have to tell you that. You already know it. Is the business in compliance with applicable state, federal, professional, cybersecurity, privacy laws or requirements? Okay, do you do business in New York? Are you compliant with New York DFS? Do you business in Colorado? Are you compliant with Colorado law? In your own state? How about GLBA? You compliant with these things? If you are, well, then you're in good shape on this question. If you're not, you got a problem. Does the business have significant online presence? That may or may not be the case, depending on you. Does the company develop and or maintain online applications that collect sensitive information or which are crucial to the operation of the business? You might not have these kinds of applications. You might be using third parties, like Ellie Mae and whatnot, other loan origination systems. So this might not apply. So some of these questions you might not score real badly against.
But with respect to almost every mortgage company, the mortgage industry is moving into the online realm, and more of the mortgage process is going to be online. Even if you choose to use third-party providers, you're still responsible. You're still liable. So instead of worrying about whether your systems are secure, you have to go look at whether the third-party provider that you're using, whether their systems are secure.
That is correct. Thank you, Mitch. Does the company have a written cybersecurity program? Most mortgage lending companies do not have a written cybersecurity program. Is an executive level employee responsible for this program? Is their compensation tied to the cybersecurity of the company? Well, probably not. Maybe, but probably not. But you need that level of executive commitment to the program, or you don't really have a program. Would a cyber incident that affected the company's reputation impact the value of the company? That's an excellent question. What's the nature of the incident? How big was the incident? Did the word get out on it? How well were you prepared for that incident?
We just saw an incident. Excuse me. We just saw an incident that affected the mortgage industry where a fourth party, that's a third party's third party, breached 28 million documents, as I recall, something in that order.
Yeah.
That involved a number of lenders. And ultimately, people are going to go back to those lenders and say, I don't care that you chose to outsource this. It's your problem. Go fix it, and you pay me.
Would the company be negatively impacted if their online systems, internal or public, were taken out of service for a week or a month due to a cyber incident? We have some clients where we have done programs for them, in terms of having a big problem and shutting down business, and a lot of times they can put together disaster recovery programs and business continuity programs where they can make it for a week or able to get their systems back up pretty quickly. But in order to do that, they've got to be highly organized and really prepared for it. Do you have that kind of capability? What kind of cybersecurity insurance does the company carry? Okay, here's a big question. What kind of, because the insurance comes in after everything else. You've been through everything else. What kind of insurance do you have? And the coverage is it's a non-standard policy, so you've got to know what's in that policy. A lot of times you think your general liability is covering you. It's not covering you on this. Has the company ever had a cyber incident? Virus, ransomware, business email compromise, wire fraud, breach of NPI that you know of? That's a factor in your valuation. So you can see we've covered this pretty quickly here, and at this point we'd take questions, but of course that's not the nature of this presentation here. But if you do have questions, contact us about this. If you have any kind of cybersecurity issues in your mortgage lending company and need some help, we are the people that are recognized as the premier cybersecurity company for the mortgage lending industry, and we'll be happy to help you. Mitch, do you have any final comments?
I do not. I think that you covered it pretty well, but I think that, it just brings the point out that cyber risk is becoming a mainstream problem for the mortgage industry as it moves more and more into an online world, and more also to this third-party matrix operation, which really adds risk to the equation, because even though you're responsible for things, you don't necessarily have as much control as you would otherwise.
Very good. Thank you, Mitch. We appreciate your time today. Give us a call if you need any help. Goodbye.